Hey, it's Similolu here, and in this video I'm going to go over candlestick patterns for consistent day trading profits. Now, I wish somebody had taught me about candlestick patterns way back when I started trading. It was almost an impossible feat trying to consistently make profits. But ever since I've been introduced to candlestick patterns, I will never ever trade without them. Now, if you want to improve your trading game, you've come to the right channel. I'll go over 5 candlestick patterns, but I'm going to save my best and favorite one of all till last. So let's get right into it. Candlestick charts are used by traders to determine possible price movement. They can be displayed in different time frames and help traders determine information at a glance with just a few price bars. Candlesticks are used when trading to show 4 price points: the open, the close, the high, and the low through a chosen time period. A candlestick has 3 main parts: a body, which represents the open to close range; a wick, which shows the highs and lows over the candle's time period; a color, which indicates the direction of market movement. Green indicates a price increase, while red indicates a price decrease. Candlesticks reflect market sentiment, with a long green bar closing near the high representing a bullish candle and a long red bar closing near the lows representing a bearish candle. It's important to take note that the open on a bullish candle is at the bottom of the candlestick, while the close is at the top. Unlike with the bearish candle, where the open is at the top and the close is at the bottom. The presence of a green candlestick is as a result of there being more buyers than sellers. The converse is the case with the red candlesticks, where it will be red on account of there being more sellers than buyers. Each candlestick in this video will focus on a daily chart, where each candlestick represents a day's trading. There are so many benefits to using candlestick patterns. They can help you identify support and resistance levels, inform you on market indecision, or help you identify continuation patterns. A standard Morningstar pattern consists of 3 candles. The first candle is a strong red bearish candle. The second one is a special candlestick called a spinning top. The third one is a green bullish candlestick with the length at least equal to half of the first candlestick. A Morningstar pattern is considered a shining beacon of hope in the midst of a downtrending market, hence its name, Morningstar. It signals the end of selling pressure with the onset of buyers who send the market back into an uptrending one. A hammer is a type of bullish reversal candlestick pattern made up of just one candle. The candle looks like a hammer, since it has a long lower wick and a short body at the top of the candlestick with little or no upper wick. It is usually found at the bottom of a downward trend. It shows that even though there was earlier selling pressure, ultimately a strong buying pressure drove the price back up. The color of the body can be either red or green, where a green body shows a stronger bull market than a red body. A doji forms when the open and close of a security are virtually equal. The length of the upper and lower shadows can vary, and the resulting candlestick looks a bit like a cross, an inverted cross, or a plus sign. A doji conveys a sense of indecision, or if you like, tug of war between buyers and sellers. Prices move above and below the opening level during the session, but close at or near the opening level. So neither the seller nor the buyer was able to dominate that candlestick. A shooting star candlestick pattern is so called because it forms a candle that looks as if a star is shooting downwards. It is a bearish reversal chart pattern that is characterized by a small body and long upper wick with a little or non-existent lower wick. It is also one of the particularly reliable bearish candlestick patterns that signals the end of an upturn. Once this occurs, it is highly advisable that a trader close any long positions or get ready to short the market. A bullish engulfing pattern is formed with two candlesticks, a small red candlestick followed by a larger green candlestick that completely encloses the body of the smaller red one. A bullish engulfing candle will usually occur at the end of a downtrend, after which will follow an upward move in price action. The converse is the case with a bearish engulfing candle. It is made up of two candlesticks, a small green one followed by a larger red one that completely engulfs the body of the green one. A bearish engulfing candlestick will usually form at the end of an uptrend, subsequently resulting in downward trending price action. So that's all, folks. I hope you found some benefit in watching this video, and I hope you'll be able to incorporate some of these techniques and patterns into your day-to-day trading. Let me know how it goes. Drop a comment below. Don't forget to hit that like button. That really helps small channels like mine grow. Share with your friends and family. Subscribe if you haven't. And most importantly, don't forget to hit that bell so you get my videos as soon as I upload them. And I'll see you on the next video.